Welcome to the Riskwiser Zone. I'm your host, Lewis. Today, we're diving into the world of junior exploration companies and a significant development in the mining sector. VR Resources, a company focused on copper, gold, and critical metals exploration in Nevada and Ontario, has announced a further upsize of its brokered private placement led by Centurion One Capital to $2,750,000. This move indicates a strong interest from investors in the company's projects and potentially reflects a growing optimism about the future of these metals in the market. The upsized financing round is notable not just for its size, but also for the parties involved. Centurion One Capital, with its mission to support visionary entrepreneurs and fuel their ambitions with transformative capital, brings a level of expertise and network that could be pivotal for VR Resources as it advances its exploration projects. The company's own proven track record in early-stage exploration, discovery, and M&A provides a solid foundation for these new investments. It's also worth considering the broader context of the mining industry and the critical metals sector, which are facing both opportunities and challenges. Factors such as general economic conditions, legislative developments, and market fluctuations can significantly impact companies like VR Resources. However, the demand for certain metals, driven by technological advancements and sustainability efforts, presents a promising landscape for exploration companies that can navigate these complexities effectively. As with any investment or development in the mining sector, there are risks and uncertainties involved. The forward-looking statements from VR Resources itself highlight the potential for differences between anticipated results and actual outcomes due to various factors. Nonetheless, this upsized private placement is a vote of confidence in the company's strategy and the potential of its projects. We'll be keeping an eye on how this development unfolds and its implications for both VR Resources and the wider mining industry. For now, it's clear that there's significant interest in exploration companies with promising projects, and investors are willing to back those they believe have the potential to make substantial discoveries or advancements. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone, folks. We're glad you're still with us as we dive into the latest news from the world of finance and autos. Today, we've got a doozy for you. General Motors has taken a $6 billion hit due to its decision to pull back on electric vehicle plans. Now, this isn't exactly a surprise, given the soft demand in the EV market, but it's still a significant blow to the company. As our friends at Yahoo Finance reported, GM's charge comes on top of a $1.6 billion write-down in Q3, bringing the total EV-related charges to $7.2 billion. The company is pivoting some of its EV plants to produce gas-powered SUVs and trucks instead, which might seem like a step backward, but it's all about adapting to changing market conditions. Meanwhile, Ford Motor Company is having a better day, with its stock surging after an analyst upgrade from Piper Sandler. The firm raised its price target for Ford from 11 to 16, citing the company's impressive autonomous driving technology and plans for a new EV platform. This could be a significant boost to Ford's revenue and profitability in the long run. Now, it's worth noting that both GM and Ford are facing similar challenges in the EV market, with soft demand and high production costs being major hurdles. But as we always say on this show, when life gives you lemons, make lemonade. Or in this case, when life gives you a $6 billion hit, use it as an opportunity to reassess and adjust your strategy. As investors, it's essential to stay informed about these developments and understand how they might impact the companies we're invested in. So, what does this mean for you? Well, if you're a GM or Ford shareholder, you might want to take a closer look at their latest earnings reports and see how these changes will affect their bottom line. The auto industry is always full of twists and turns, but one thing's for sure, we'll be keeping a close eye on it. Welcome back to the Riskwiser Zone. As we wrap up today's show, let's take a look at some of the latest developments in the world of business and finance. We've got a few interesting stories to dive into, so buckle up. First off, it seems like Nike is facing some challenges. RBC Capital Markets has lowered its price target on the company to 78 from 85, citing pressure from Greater China, weakness at Converse, and U.S. tariffs as major concerns. Despite this, the firm still believes that Nike's path to profitable growth remains intact, even if the timeline has been stretched out a bit. Meanwhile, Puma is making headlines with rumors of a potential sale. Antisports has reportedly made an offer to buy a stake in the German sportswear brand, although the deal seems to have stalled for now. It's worth noting that Puma's CEO, Arthur Hoyled, has acknowledged that the company needs to correct some key issues, including a lack of brand heat and too much inventory. It's also worth mentioning that Nike is heavily dependent on China, with roughly 18% of its footwear still being produced in the country. This relationship has been lucrative for decades, but it also carries some risks, such as technology transfer and brand dilution. In fact, Nike shoes are among the most counterfeited products globally, which could be a major concern for investors. As we look at these stories, it's clear that the business world is constantly evolving, and companies need to adapt quickly to stay ahead of the game. Whether it's navigating global supply chains or managing brand reputation, there are always risks and opportunities to consider. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe, and until next time, keep your finances in check.